Welcome to Stocks Review. Click the subscribe button for more up-to-date stocks and portfolio review. Today we are going to take a look at AMC Entertainment. Stock ticker symbol AMC. It is headquartered in the USA and service regions majorly in the United States. You may ask why we should care about where the company is headquartered? This is because companies in developed countries tend to be better regulated, whereas companies in developing countries tend to have higher growth, but also more risk. It has a market cap of $8.5 billion and is considered a mid-cap company. The market cap is an important metric because companies with larger market cap often have more pricing power, liquidity, and lower failure rate, whereas companies with smaller market cap tend to have more growth potential. What sector and industry the company is in greatly influences its ability to deal with market uncertainty. It is in the communication services sector and entertainment industry. AMC Entertainment engages in the theatrical exhibition business. The company owns, operates, or has interests in theaters in the United States and Europe. As of March 1, 2022, it operated approximately 950 theaters and 10,600 screens. The company was founded in 1920. In short, it is the largest movie theater chain in the world. The stock price has performed very badly recently. It has a 5-year price return of -32% and significantly lags the SPY. The 5-year price chart may help us evaluate how a company performed recently and its ability to weather global events, such as trade war, pandemic, and supply chain issues. It has a 5-year compound annual revenue growth rate of -4.8%. The revenue growth is absent and the revenue trend looks very bad. The revenue trend is important as growing companies often have sales go up first, followed by profit growth. On the other hand, when sales become stagnant, it may also give us a hint that the growth phase of the company may come to an end if no critical change is made. It is not profitable now. The net income trend looks very bad. The profit is going deep down in the negative. This is not a good sign. The net income is one of the most important metrics an investor should be aware of. In the long term, stocks always follow the earnings trend. It has been issuing more shares in the recent years, probably for funding its growth. We should always follow closely if a company is buying back or issuing more shares, as both of these activities greatly impact the return shareholders can get. It has just slashed its dividend recently. That is not a good sign. The dividend history gives us a peek of a company's cash flow stability. The overall shareholder return of AMC Entertainment is very bad and significantly lags the performance of the SPY. The total return and annual growth rate history of a company can show us what the performance trend was and how it had navigated through difficult times. Most companies tend to perform similarly, with a slight decline in growth as time goes by. AMC Entertainment has a 9-year total return of 11% with a 9-year compound annual growth rate of 1.1%. If you had $1,000 invested 9 years ago, you would have $1,110 now. Currently, the price is at around 16.5, with a 52-week high at 72 and 52-week low at 9. It is near the lower end of its 52-week range. It has a P/E ratio of -6.7 and forward P/E ratio of -18.9. It has a cash position of $1.6 billion and long-term liabilities of around $10.8 billion. The ratio of cash, debt, and market cap may help us evaluate the default or bankruptcy risk and what % of your share is eroded by debt. Higher debt also has a higher cost in an elevated interest environment. It has more long-term liabilities than its market cap. That is not a good sign. AMC Entertainment is considered a narrow moat company according to Morningstar's rating. Now, about the future projection. Currently the margin is minus 50% and future margin after 5 years is expected to be minus 3.1%. The margin is expected to be increasing a lot after 5 years. The company's margin and moat reflects the pricing power of the company, and the projected trend is also important. We want to own a company that is able to stay profitable and relevant. It has a 5-year forecast revenue compound annual growth rate of 15.4% and 5-year forecast EPS compound annual growth rate of minus 215%. The near-term growth is expected to be good. It has equal beats and misses of analyst consensus EPS estimates in the last 4 quarters. That's not an impressive result. The overall analyst recommendation rating is a hold with trend shifting towards buy recently. The rating trend gives us a clue of the changes of what analysts thought about the stock. Out of 7 analyst 1-year price targets, the range is 1 to 35 with an average price of 10.45, which is well below the current stock price. The discounted free cash flow model is a widely accepted method for valuing a company. Here we present 3 kinds of discounted free cash flow model results for a more comprehensive review. If we run the DCF perpetuity growth model, the fair price is 9.8 with a downside of 43.3%. If we run the DCF terminal EBITDA model, the fair price is 7.9 with a downside of 54.4%. If we run the DCF terminal revenue model, the fair price is 18.6 with an upside of 7.6%. Now we compare AMC Entertainment with US Treasuries and SPY. It cannot be emphasized more that the US 10-year Treasury yield is one of the most important numbers to keep in mind when investing in stocks. The 10-year Treasury yield affects the valuation multiple of stocks like gravity. The higher it is, the lower the stocks are valued, including all the S&P 500 companies and all the stocks in the world. Currently, the 10-year Treasury yield is around 2.9%. The SPY is considered one of the safest and most liquid ETF for investing in the stock market. Big funds and investors directly compare the risk and return of investing in SPY or in individual stocks. The historical return of all stocks follow the earnings trend long term. However, the real return is often reflected by a mix of dividend and buybacks together with revenue or profit growth affecting the valuation. The return yield of SPY is at around 10%. The SPY has an average forward PE around 18.8 now. AMC Entertainment has a dividend plus 10-year growth forecast plus shares buyback yield at minus 28.7% and a forward PE around minus 18.9. We have to be cautious that this is just a rough prediction of AMC Entertainment's future performance. The forecast can be changed at any time, and the actual revenue or net income the company is able to get depends heavily on the true market condition. Looks like AMC Entertainment is more expensive than the SPY, and SPY looks like a better buy with a more stable return estimate. We will try to summarize all the information above to give us an overall impression of AMC Entertainment. In summary, AMC Entertainment is a mid-cap high-debt company with small growth and narrow moat, and probably overvalued now. If AMC Entertainment can deliver more growth than estimated and turn to profit faster, it may be a stock to consider. Now that's a review for AMC Entertainment stock. Click the subscribe button for more up-to-date stocks review. If you like our content, leave us a comment and click the like button to give us some support. We hope to see you next time.